All right, so in Chapter 8, we're going to be looking specifically at the balance sheet and accounts receivable and notes receivable. We're going to also be exploring how do you write off what they call a bad debt, and then we'll also show you how to calculate interest on the note receivable. All right, so first off is we'll talk a little bit about some of the pros and cons of why businesses would extend credit to begin with. Obviously, if it increases the seller's revenues, it's much easier to conduct transactions if you don't require your customers to have to pay you right then and there. So that's going to increase your advantage, your revenues. But at the same time, by extending credit, it will delay your receipt of cash. It also is going to increase your risk because you could actually lose some of that cash. And then you're probably going to have more personnel involved in keeping track of the accounts receivable. So your overall salaries and your business expense could also go up. But the big thing, the big pro is the fact that it will increase your revenue because you can do a lot more transactions if you can say pay me later. All right. So some of the effects when we get to estimating some of these bad debts, first of all, you have to go back to remember that the beginning of a transaction to establish a sale, and we're calling this a credit sale, a sales on account, is that you would debit accounts receivable and credit sales revenue. And of course, we all know that the accounts receivable goes on the balance sheet. That's going to be cash expected to be paid later. And then there's your sales revenue on the income statement. Now, at some point in time, it's very possible that some of these accounts receivables may not be collected. So at some point in time, you're going to have to estimate a bad debt. And so remember, we always have these time periods. So if the income statement says for the month of January, we want to report all the revenues according to the 5-step model. And we also want to make sure that we match up all the expenses that follow that revenue. And a bad debt expense would definitely need to be paired up with any sales revenue in that period. So you'd have to estimate what they call a bad debt. And here's going to be the adjusting entry. Later on, we'll show you the methods and how you do your estimates, but you would be debiting what's called a bad debts expense and crediting what they call the allowance for bad debts. That's a contra asset. So you notice on the balance sheet, it's going to be a credit balance, just like accumulated depreciation. That's going to reduce your receivables. And then, of course, this bad debts expense will reduce your income. So this is an entry. Usually it's an adjusting entry that you'll have to do usually every period or every year to make sure that you're following GAAP. So again, on this slide, they're just showing you that, again, on the balance sheet, you would have accounts receivable, the gross amount, minus that allowance, which includes your estimated receivables that are going to go bad. And then the difference is what they call your net accounts receivable. All right, so again, the allowance method is what we call this. And again, typically you have to make an end of period adjustment to record this bad debts. And then the second part is when you actually remove the accounts receivable from your books. That's usually when it's called a write-off. And that's usually once you determine that that customer will indeed not be able to pay you. Okay, so just walk you through the steps. So here's typically how it works. You would make your adjustment. So just for example, let's say there's an estimated $900 of bad debts. Notice you're going to have a contra asset. Your assets will be reduced. You're going to increase your expense, and you would record an adjusting entry where you'll be debiting bad debts expense and crediting your allowance for doubtful accounts. And again, they're just trying to show you here how you've got the matching. So here's your credit sales in this period. They're debiting accounts receivable, crediting sales revenue. And this would be the matching principle where you're matching up this expense that's going to offset that revenue on the income statement. So this adjustment would be entered into this income statement to offset the revenue. That's the conservative principle in accounting and matching. And then this allowance is going to actually write down your total assets by, in this case, the total allowance was at $15,000, but this 900 would just contribute to that, help increase it. All right, and then later on, when you end up writing off the account, you would be reducing your accounts receivable, and also reducing the allowance account. Remember, the allowance account would have a normal credit balance. So by debiting it, that would be reducing it. So debit the allowance and credit the accounts receivable. So again, here, just kind of showing you again, if you're going to write it off, you can see how you had your bad debts expense in your allowance. And then here was your write-off. Notice that this was your estimate of 900 and they wrote off 800. So quite often is that your estimate typically will differ from what you actually indeed write off. But hopefully you can see how once you post these that your accounts receivable would be going down, and then there's your allowance going down, and then of course there was your bad debts expense adjustment. All right, so to do these estimates, there's two acceptable methods according to GAAP. One is called the percentage of credit sales method, which is what they call an income statement method. And then the other one is called aging of accounts receivable, which is more of a balance sheet approach. The second one is the one that's more accurate. I'll show you exactly why in a moment. The percent of net credit sales is simply is a simple method where you're simply just applying a percentage times your overall credit sales. And so in the next couple slides, we'll show you how you do each of them. So percent credit sales methods, pretty much they'll give you in the problem, you'll have your credit sales, they'll give you the rate in terms of the percent you think is going to go bad. You simply multiply that rate times your credit sales, and that's going to be your bad debts expense adjustment for that period. That's all you have to do. So you'd simply, in your adjustment, you would debit bad debts expense and credit allowance for doubtful accounts. This is the method that in my applied accounting courses, this is the method that we do. All right, now the next one is the one that you probably didn't do in applied accounting, which is the aging method. And again, earlier, this one is called more of a balance sheet approach because your focus is on the allowance for bad debts account and how it's presented on the balance sheet. So the first step is you have to kind of line up who owes you money and totals. And then what's going to happen is you're going to have how many days each of the amounts are past due. And then eventually you're going to apply a probability or a weight to each of these columns to estimate the likelihood that you will or will not collect those bad debts. And then when you add them all up, that's going to be your total estimated bad debts. So you can see down here at the bottom, you have these percentages, which are like weights. And notice once you get to longer periods of time that they haven't paid you, the probability that they are going to pay you goes down. So notice there's a 40% chance that you're going to have a bad debt anytime it's over 90 days past due. Anytime it's 0 to 30 days past due, they're estimating you only have about a 1% chance of having these amounts go bad. So what you do is you take these percentages and multiply them by your total categories, and then at that point you just add them up to get your total estimate. And that's what they show you on this slide. So again, 1% of 120, 10% of 45, 20% of 37, and so forth. Add these up, the 15,500 would be your total estimated bad debts. So then the next step is a little bit different than the percent net credit sales method. What you do is, if I'm in my class, I typically draw a T account. I would say allowance for bad debts, and this estimate would be the forced or required ending balance. They call it the desired balance for this account to be presented on the balance sheet. So your adjustment will be the difference between whatever the desired balance is and what the current balance is. So in this example, before any adjustments, they're saying allowance had a balance of 14,200. We want that balance to be 15,500. So the difference is 1,300. So if you plug a credit in here of 1,300 plus 14,200, that would give you the desired ending balance. So you can see on this slide, again, they're showing you that. So on the adjustment, you'd be debiting your bad debts expense, crediting the allowance by that 1,300. Notice allowance goes up by 1,300. So making the adjusted balance 15,500, which is what you want the total estimated balance to be. And then your bad debts expense simply would just be at 2,200 for totals. All right. Other issues with writing bad debts, oftentimes when you may have to do some revisions of your estimates. And bad debts estimates, they're always different than what you write off later on. So sometimes companies always have to be aware of to make sure that their estimates are accurate. And then also sometimes you have recoveries. What that means is you might have a customer who you'd written off that they later on came back to you and said, we still like to pay you. And so there's accounting, bookkeeping you have to do to be able to show the recovery of that previous write-off. So typically what you'd have to do is go ahead and put that money back on the books by debiting the allowance, debiting accounts receivable, crediting the allowance that reverses the write-off, and then simply debiting cash and crediting accounts receivable for the actual cash collection. So there's actually 2 entries that you have to do on this recovery. All right, I think I explained that one already. All right. Other issues in this chapter, you might have to deal with interest. Typically, you might have interest on notes receivable, which is simply like you're loaning money out, but you charge interest on the principal of the amount. And so the basic calculation here is I think called PRT, principal, times the interest rate times the time period. So in this case, the principal amount in these scenarios is 100,000, 6% is the interest rate, and they give you the maturity of the note. So if you want to figure out the interest for each of these periods, the first one it says for 1 year. So you take that principal times the interest rate. And the reason they're taking it times 12 over 12 is because typically the interest rates they give you is an annual interest charge, annual APR, annual percentage rate. So by simply taking 12 months over 12 months, 12 over 12 is 1 year, times 6 times 100, that would give you your yearly interest. For the second one, January through October is 10 months. Notice that changed to 10 out of 12 months, 10/12ths of a year. So it's the same calculation, but it's not a full year, it's 10/12ths. Notice that's 5,000. From November through December is 2 months. Notice a fraction, that's 2 months over 12 months, times 6 times 100 gives you $1,000 for those 2 months. So that's how you calculate interest. And then later on, we'll show you how to do some accruals using that concept as well. So again, this slide, again, is just showing you, you do have to look at the dates, and they'll keep it pretty simple in the book and in the problems. All the dates will start like at the beginning of a month. They should give you the annual interest and, of course, the maturity date and, of course, the time periods that you're looking for. So in this case, they're just showing you if you had the last 2 months of the year and then 10 months of the next year, if you're trying to figure out the interest for 1 year. You'd have 2 12s and then 10 12s. Notice 2 months and then 10 months. If you have to split that interest, sometimes you're going to have to do some accrual accounting to do that. All right, so to show you again how you would establish a notes receivable. So we would debit the note, credit the cash that we're lending out. And then sometimes you'll have to do that accrual. So in this case, we had November 1st through December 31st, that's 2 months. So the time period is 2 over 12. That's where they get that. The interest rate is still at 6%. Again, that's an annual rate times your principal. Gives you $1,000 of accrual. So at some point in time, you're going to have to debit other receivable. So you would debit interest receivable, credit interest revenue. This is accrued revenue for $1,000. Again, it comes down to time periods once again. Now, eventually, you might have this over a couple periods. They're showing you here from January 1 through October 31st, how you calculate the rest of the interest, which is simply the 10 over 12. So that's 5,000. So in total, we're going to get $6,000 of interest. We know that. And so if we don't actually get that interest till October 31st, then let's show you the calculation of the journal entry in terms of how you would record that. Notice, you still get the full $6,000, but of your receivable that you established during your accrual, you're going to have to reduce that 1,000, and then the difference, that 5,000, that's simply the revenue coming in for the last 10 months of the current year. So that's how you do the interest. And then eventually, you would need to get the principal back, and so you'll simply just debit cash, credit notes receivable for the principal that you had loaned out to the customer or the client. All right. Last couple things is looking at the ratios. You have your receivables turnover and days of collection. And let's just jump right to the calculation. You take your net sales divided by average receivables, beginning plus ending divided by 2. This simply just tells you how quickly do you collect in terms of how often do you turn over your receivables. And then when you take 365 and divide by that, that tells you approximately how many days does it take you to collect your receivables. So typically, you want this number to be large because that will make your days to collect a lot shorter. You want that because that will show investors and creditors that you're collecting your cash quicker. And that's, of course, is what you want as a business too. So when you look at this slide, you notice they've got some comparisons of the turnovers and the collections. And you notice the one with the highest turnover has the lowest number of days to collect. And that's the best scenario that says that you're collecting the cash quicker. And that's what you want. Because once you get that cash in, you're reducing your risk. All right. And then, of course, businesses can apply certain methods to get that cash coming in. You can sell off your receivables, kind of like a commodity. Of course, there's a factoring fee, but of course that would get cashed into the door quicker. And then you can also, do some other issues, some agreements with your customers to allow them to pay using credit cards and so forth. But again, there's different ways you can establish discounts. I have to say, if you recall the 2, 10, and 30 scenarios, that also would encourage your customers to pay you sooner. All right. A couple more things. There's also what they call the direct write-off method. This is going back to a supplement A in the book. This is non-GAAP. Notice again, direct write-off method does not follow any matching. You simply just write off the debt as it becomes known. And so in other words, your expense may not match up with the revenue in the appropriate period. And so the example, all you do is once you know what that bad debt write-off is, you simply debit the bad debts expense, and notice there is no allowance. You just credit the accounts receivable. Again, this is non-GAAP because it's not good matching. All right, so that's it on the Chapter 8 lecture video. And then coming up, you'll have some textbook videos and some homework illustration videos that we'll also put on the Blackboard for you.